Let me now bring on board Pathik Gandotra, Head of Equities with IDFC Securities. Morning, Pathik. Thank you for stopping by. Pathik, 2011 was a rough, dangerous and a volatile year for Indian investors. So at IDFC Securities, what is your house view for the calendar year 2012?
We were positive on the market for the last quarter, from the last quarter onwards. So we continue to remain positive. Our view is that, interest rates are will be the key driver of the markets in the year to come. And if you see signs are already visible, you see inflation numbers, at least on the food inflation side, coming off. I think the overall inflation number will also start coming off, and you will see government bonds tracking that already. They are down by about 60-70 basis points from their highs. So I think that you are about a couple of months away from RBI's first rate cut. I think RBI will have no option but to cut rates aggressively through next year, because the growth paradigm is shifted significantly downwards. And so you will have a situation where you will have weak growth in the first half, but interest rates will come off, and eventually that will lead to eventually a growth revival. I think the growth revival will take time, but the point is the building blocks will be laid in the year.
So Pathik, looking at these following catalysts that you just mentioned, when can we see a meaningful recovery for the markets as such?
I think the biggest risk for the markets for the next 2-3 months is what happens in Europe. Now, eventually, these guys will be able to sort out their problems, because, if I don't think the euro is going to break down. I don't think there'll be a big crisis of Lehman kinds. But the point is that you will have a lot of volatility, because the negotiations, and if the negotiations get made public, you will see a lot of conflicting news reports coming into the next year. And so you will see volatility associated with that. You could see some significant negative news flow also coming through, which would lead market significantly lower. So my point is, once you get to the volatility in the first quarter, I think then you should be okay. By that time, you will have interest rates also getting cut, and then you will be on the road to recovery in the markets.
Do you think 2012 is a year where stock pickers will make money? Index may remain range bound, benchmark indices may trade in a volatile and a narrow range for the entire year, but if you get the stocks right, you will hit a jackpot.
I'd rather say if you get the sectors right, because I don't think, stocks right was a view that you could have taken last year. But, this year, I think if you get your key sectors right, then you'll make money. And I mean, by that I mean all interest rate sensitive should do well. And, to begin with financials, I mean, the entire pack should do well through the year.
Pathik, you just talked about as to how going in the near term, the RBI wouldn't have a choice but to cut rates. In this month's policy, though, does it seem like it is going to be a pause? And come April, we will see interest rates actually start to tapering off.
So as far as interest rates are concerned, most definitely there will be a pause. They will not cut interest rates this month. But they could do something around liquidity. They could possibly cut CRR in this policy, because liquidity is already very tight, and so the banks could do with some respite.
I think, what are the feelers you're getting from some of your top institutional clients? Are they in a buy on decline mode, or they currently are in a buy mode?
Currently they are in a short cutting mode. So everybody has cut his shorts. I think most of the funds in Asia and US have cut short significantly. I would still not say they are looking at buying, but we had a midcap conference last week, and that was very well attended. It was the amount of interest that we saw in midcaps coming out from both local and foreign funds was quite amazing. And so they are looking for ideas to invest with. I think the preference is to get stocks with decent managements and good valuation, which I think are available in plenty in the current market.
Do you think in terms of sentiment, we are at a bear market low, but in terms of valuations, we still have 10%, we potentially could see some more downside?
Yeah, definitely, because that's what I'm saying, that if an event in Europe unfolds, which is even mild in nature, you could see a downside in your stock prices, because you're not at the bottom of valuations. But I guess the risk-return trade-off is still extremely favorable. So
for markets to correct 10%, something globally has to go wrong. All the local bad news to your mind is baked in, whether it's inflation, high fiscal deficit, or corporate India which is slowing down.
That's been discussed to death already, and everybody expects that completely. If you look at the earnings estimates that out of the brokers have put out. I mean, our estimates are 5% growth for the index, and I've seen estimates which are pointing to a flat or even a decline for the Sensex. So, it's already there in the price. People have cut numbers significantly. They might cut numbers a bit more. The point is, I don't think earnings will make such a big surprise for the market anymore.
If that was the case, why did Infosys correct by 8%? I mean, Infosys numbers were just a shade below estimates, and look, stock went down 8% on Thursday.
No, that is because the outlook that he gave. People expected him to give an outlook which was subdued, but they gave an extraordinarily subdued outlook. So the numbers were pretty good, and actually they beat analyst estimates.
Patrick, you were just talking about, your mid-cap conference. Give us a sense of what is the kind of flavor or inquiries in terms of sectoral pockets. Are you seeing now that defensives are, turning out of favor and people are getting into, pockets where there would be a lot of valuation catch-up, the likes of infrastructure, real estate, couple of these power plays, or something where there could be some policy action like we're seeing currently with fertilizers?
So defensives are out of favor in the sense that people are not putting fresh money to work there. It's not as if people are selling out of consumer stocks. That's not what is happening. And so the fresh money, if at all it comes, and there's some portfolio reallocation also. So you could see that if people were not getting money, they would be taking a bit of the weight outside defensives and putting into taking on beta. Like I said, financial as a sector is working like a sector. But others, say for infrastructure, people are very selective on stocks. So just to your earlier question as to are people selective this time around? Yeah, people will be selective on sectors like infrastructure and capital goods, where they would like to go with least controversial, highest visibility managements, where they will put in money.
Is it time to buy a stock like BHEL? BHEL at the peak of bull market was trading at 25 times. Now it's trading at about 8 or 9 times, depending on the estimate you track. Is it time to start buying L&T, BHEL, ABB, Siemens?
Out of all the four, I'd pick L&T.
Why is that?
Because I think L&T is where it's a diversified business with multiple earning streams. As interest rates come down, there'd be a multiple expansion for the fact that capex will pick up. And the government has started spending selectively. So L&T is a big beneficiary of that. And then overall it's a large liquid stock. Somebody wants to take some exposure on the infra space, he goes and buys L&T.
Patrick, give us some mid-cap names where there is money to be made in 2012.
So there are companies like the whole Hathway, then that pack, that's one. Then financials, a company like a bank like IndusInd Bank, Yes Bank. Amongst the smaller banks, Allahabad Bank. If you look at Syntex, we think we are very, very bullish on Syntex because we think it's been hit by just mark-to-market impact of the of the rupee depreciation, but actually nothing seriously has gone wrong with its earnings. What
makes you bullish on some of these cable stocks? Prospect of M&A or the fact that the entire industry is going through a transition phase? Analog will soon become digital.
I think the latter, because there's going to be a significant regulatory change, and this time around I think the market is believing that it's for good. And so once that whole digitization process happens, declarations improve, the earnings of these companies will improve very significantly. In an industry like that also attracts foreign capital. So all of that put together is what's the case that's being made for the industry.
What's your eventual price target for something like a Hathway or a Dish TV? Because like you said, these are concept stocks and it's difficult to put a number to a concept stock when the industry is going through a transition.
So exactly, it's very difficult to put a price target. So I think as earnings and events keep unfolding, you can see a 20-25% compounding of these stocks for the next 2 to 3 years. I'd just like to add a few more stocks to what our list was. So we like ING Vysya Bank also, which is a private bank available at a very, very, very decent valuation. And the earnings, if you see for the last 6-7 quarters, are doing exceptionally well, but the stock has somehow not performed. So I think with earnings coming through, valuations on your side, I think that's a stock to look out for. We also like Jaiprakash Associates, which is our pick in the infra space, where we think that the action on the ground is very significant. You are seeing projects getting implemented. The big power project has got implemented. On the road, they're making significant sales from homes. So all the three companies of the Jaiprakash group we think are looking pretty exciting to us.
So for someone who's a retail investor, has just 1 lakh rupee, has got limited appetite, should that retail investor split that into 4, buy 2 cable companies, buy ING and buy JP?
No, I said 4 other stocks earlier.
Okay, split equally.
Yeah, so I think that's what I would suggest. But I would say, I would still advise investors to buy the stocks with relatively lower risk. I mean, if it's a retail investor, you can buy some of beta, which is like a Jayaprakash is significantly high beta. But the point is, it's a stock which you should own.